Good evening, guys. Welcome back to today's class. All right. So far we were seeing, very much into theoretical and so many concepts we have seen. All right, in previous classes and all those things. So today, what I thought is, okay, let me take you through the MCQs because we have seen few accounting standards. We have seen few, concepts also. So now it's time for us to revise all those things and we can understand other concepts also via MCQs. All right. So now next first question we are going into this one. Now see, this question is from AS2 Accounting Standard 2. All right. I'll read the question. You will understand that. Normal capacity is 1 lakh unit. That is, a machinery can produce at a normal capacity of 1 lakh. Actual production is 1 lakh 20,000 and the total fixed cost is 10 lakh and the fixed cost allocated to the inventory would be. So now the question is how much the fixed cost will be apportioned to each unit. Okay, now this particular concept we have seen in our lecture, right? So what it says, if the actual production is greater than the normal production, then the allocation would happen in such a fashion that total fixed cost will be apportioned over what? It will be apportioned on what ratio? As on actual production ratio. Correct. Suppose if the actual production is lesser than or equal to normal production, then in that case your total fixed cost will be apportioned based on what? Normal production. This is what we have seen. That is per unit allocation I am talking about. So here per unit would be how much then? Now the cost is 10 lakh and the now actual production is 1 lakh 20. Correct na? So now 10 lakh divided by 1.2 lakhs. So it would be 8.33 per unit. So the answer is B. Alright. This particular concept we have seen in our AS2 ka lecture. Alright. Next one. Inventory of finished goods will be valued at. Guys, again this is relating to AS2. Right. Again this is relating to Accounting Standard 2. Now please remember we have seen that this valuation will happen. All right, this inventory will be valued. Inventory is divided into two categories, right? One is raw material and one is finished goods or WIP. All right, because the provision for finished goods and WIP remains same, so that's the reason I just grouped this into one, these two categories into one. All right, so now the finished goods will be valued either at its cost or at its NRV, whichever is lower. This is the provision given, so the answer is B here. You are getting it. Raw materials, it will be valued at its cost, but provided there is a condition which says that if the sale price of the finished good should be, or at least it should be equal or it should be greater than the cost price of such finished good. That is the condition they have laid out. If it is not so, then the raw material will be valued at its replacement cost. This is the provision given for the valuation of inventories as per AS2. All right. Next question. In case of sale of goods, the revenue will be recognized when? Guys, understand this is related to your Accounting Standard 9, revenue recognition. This also we have seen in our lecture. All right. So remember that when AS9 deals with three things we have seen. One is sale of goods, sale of services, and then revenue generated from the enterprise assets used by others. Say example, interest, dividend, and what else we have seen? Royalty. Correct. So now here sale of goods. When will you recognize your something? I mean, when the transaction has happened, when you recognize something as a revenue, when you recognize something as a sale in your books. So AS9 says that if it is related to goods though, then please make sure that risk and reward is transferred. And you should be able to, measure its revenue and its cost. And there should be future economic benefit. Future economic benefit in the sense, I made a sale. Definitely that person, suppose if it is a cash sales, though I would have received the cash automatically. Suppose if it is a credit sales, though obviously it will be going to give me the revenue or it's going to give me some benefit in the future. That is nothing but the paisa I'll be getting it in the future. Correct. So now what they are saying, there should be, you should be very much aware that he will be paying me. Okay, there is no bad debts or something. It's not gonna happen. I know that paisa will come. At least at the time of making sale, I'm saying I know that the paisa will come and I can measure it reliably, and the risk and the reward has been transferred. Ownership has been transferred completely. So if I satisfy all these conditions, at that point, I can recognize those things as a revenue, those things as a sale of goods in my book. So the answer would be E, all of the above. Which one of the following item is a non-monetary item? Again, this one you will come across AS11, that is foreign exchange. All right. There is a standard which tells you how to translate a financial statement which is reported in a foreign currency, and how to account for your forward contracts, and how to take care of or how to account your forex. Like forex in the sense that the transactions that are happening in a cross currency, it is not happening in INR, it is happening in a currency other than the reporting currency. Reporting currency for us is INR, right? So in India, the reporting currency is INR. So even if you have a subsidiary in Singapore, Australia, or US, UK, whatever it is, you have to consolidate everything. You have to take all the transaction that has happened across the globe, and you have to present it in your Indian financial statement. Correct? No. So when you, like the transactions happened in Singapore or Australia or UK or US, it will not happen in INR. It will happen in different currency. Correct. US, it will happen in US dollar. UK, it will happen in UK dollar, sterlings or pounds. And Australia, it will happen in Australian dollars. Singapore dollars. Right. So what happens? Each one is in different currency. But in India, we will be reporting it in INR. Now the question is, how do I report it? What rate I will convert? Is it one rate it is available? No. Every day the rates are different. No. Today the rate is one. Yesterday the rate was something. Today the rate was something. Tomorrow the rate would be something. Correct. No. So it is not one single rate that is available throughout the year. No. So now how would I account it? Because every day the rates are changing, and every country the rates are changing. So how do I account it? So all those things AS11 has given provisions how to translate. If it is a current item, so how you have to do it. If it is a non-current item, so how you have to do it. Suppose if that business operation what you are carrying out in the across the globe, or outside India, is it an integral operation or is it a non-integral operation? So there are so many provisions AS11 has given. So based on that, you will be using those kind of rates for conversions. Basically, guys, that is main thing. Because transactions might have happened in some other date and conversions might happen in some other date. So which currency I have to take it? This is one thing. Suppose when this is reporting, suppose say for example, I have purchased or say I have purchased a machinery from US. Say $1 lakh is the value of that machinery. So I purchased that machinery. Now I agreed that I will pay this $1 lakh, this much in a 5 installments. So which means $20,000 per installment I have to pay. 5 installment. Tell me that 5 installment what you're going to make, would that the rate of conversion would be the same? This month you are making $20,000, so probably 82 rupees. Next month, suppose Indian economy has improved and all those things. Now the rate has come down to 80 rupees. Now obviously you will give 80 and you will get the $20,000 and you will be remitting it. So the same $20,000 today you purchased for 82, and the next month you are purchasing it for 80, and maybe the third installment you may be purchasing it for 85. Correct. Now, so there is a up and down. There is a fluctuation. You're getting it. There is a fluctuation, and because of that, why it is happening? Because of the foreign currency. Correct. Foreign currency fluctuations. Because of that, you are ending up either getting profit or incurring losses. Right. When I get that for 80 rupees, that is a profit to me, because today if I do though, I have to pay 82, but I have paid only 80 rupees. So 2 rupees profit per dollar. Correct. Now, at the same point, if I pay 85 rupees, then 3 rupees loss for me. Correct. No. So, $20,000 is $20,000. There is no difference in that. For him, it is nothing. For me, it is not the same. Because 1 month earlier, it is 82, 80, now 80, then 85. So, there is a fluctuations in my currency. So I would be earning or I would be incurring, correct, losses, right? So now how do you account it? How do you report it? You need to tell, no, because of this only I got this so much of differences and all those things. So all those, how do you report, how do you account these forex effects in your books? That is dealt by accounting standard 11. So there one concept is called non-monetary item. So why this is coming is because it says that if it is a monetary item, though, you will be translating, you will be converting those items at the closing rate. All right, closing rate. When you are incorporating the same, when you are adding the same to your balance sheet, to your P&L, that is financial statement, you will be using the closing rate if it is a if it is a monetary item. Suppose if it is a non-monetary item, though, then you will be carrying it out at historical cost. So this is the provision. So for that, you must know what is meant by monetary and what is meant by non-monetary. You're getting it? So if I want to put it in very simple, understandable local language, current assets, you can call it as monetary item. You're getting it? Where there is a, that is not a definition, technical definition. Technical definition is when there is a definite, you know that there is a definite inflow or outflow. You know your liability, definite thing that yes, this is this much I can predict and easily, and it can be easily, what I can say, which is of a shorter duration period. Then that could be treated as monetary item. Classic example would be cash, receivables, payables, all those things. All right, accounts payable, all these things are monetary. If I want to say non-monetary, opposite of that, example would be fixed assets, inventories, equities. All right, all those things will be non-monetary item. Now here they are asking which one of the following is a non-monetary item. Obviously, receivable, payable, cash is a classic example of monetary. So equity share is a non-monetary item. Ma'am, why equity share is a, guys, understand, when I do investment in equity shares, it will become my subsidiary or joint venture or associate company. Correct. No, when I invest in an equity shares, I become the owner. So owner means it's a long-term relationship. You're getting the point. That's the reason. All right. Next question. A short-term investment which was purchased on January 2020 for 50,000 and FMV as on 31st March is 55,000, and the carrying amount of such investment as at the balance sheet date would be. Guys, please remember this is for AS 13 investments, accounting standard for investments. So again, it says that this standard talks about how do you record, what value you will carry your investments. Investments could be many things. Investments in, financial instruments, investments in, building, so many things are there. So this standard deals with those things. And please remember, as per this standard, it has divided as short-term investment and long-term investment. If it is a short-term investment, though, it should be valued at its cost or its FMV, whichever is lower. All right, fair market value, fair value or cost, whichever is lower. Every balance sheet date, you have to do this analysis. Then whichever is lower in that value, it has to be carried out. All right. Suppose if it is, suppose if your cost is less than the fair market value, no problem. You will be carrying out it at cost. Suppose your fair market value is lesser than your cost. Then in that case, what happens? You purchased for say 10,000, but right now the value is only 8,000. So you have suffered a loss. Ma'am, I didn't sell it. Ma'am, you didn't sell, but there is a notional loss of 2,000 rupees because there is a reduction in the value of the that investment. Correct? Na? So 2,000. So what AS 13 says that please account for that. So that year what you do, you bring down your investment to 8K and 2,000 rupees as a loss, you charge it to P&L. This is what they'll say. Okay, fine. Suppose next year, suppose if that value of that investment has increased, say for example, cost is 10K, I know. Now the value has gone up to 12K. Now what shall I do? Shall I bring it to 12K? No, you have to bring it up to 10,000. That's it, because whichever is lower, no. So now what will happen? You will bring back that asset to 10,000. Ma'am, now 8,000 rupees it was there. Now I am bringing back to 10,000. So how will I bring back? Whatever you charge it to P&L, you will be crediting the same to the P&L and you will be moving it to the investment. That's it. You're getting it? So it is like just to make sure that your investments are carried prudently. You're getting it? If there is any reduction in its value, that has been captured. If there is, if the reduction, suppose the, say for example, next year the cost is 10,000, the value has been increased to 9K. Okay, fine. So now what happens? Now I have to bring it back to 9K, right? Because anyway, this is the lesser one. Whichever is lower, that I have to carry. Last year I carried at 8,000. Now this year, this is first year. Second year, I will be carrying it at 9K. Ma'am, it has been increased to 1,000 rupees. What will I do? So in your P&L, now please understand, in P&L, in the first year, you would have charged 2K. Now here in your P&L, you would have entered it as a profit to an extent of 1,000 rupees. From 8,000, 9,000 it has gone. So 1,000 rupees. Suppose third year, it has come to 11,000. Cost is 10. Fair value is 11. Now what will you do? You will be valuing it at 10. So now your investment will go up to 10 to a cost. Now what happened in your P&L? Another 1,000 rupees you'll be. So here 2,000 loss, here 1,000 is a notional profit. It will get knocked off. In the sense, it is like, when you do a continuous accounting, you'll understand that. I mean, first year it would have been treated as loss, second year it would have been treated as profit. So it will get knocked off, it will get set off, kind of set off. You're getting it? So the provision clearly says if it is a short-term investment, it should be carried at its cost or at its FMV, whichever is lower. FMV as on when? As on the closing date. Closing date is nothing but 31st March. Alright. So 50 or 55, whichever is lower. 50, the answer is 50. Ma'am, you said it is short-term investment. Ma'am, so is there anything else for long-term? Of course, yes. Long-term will be carried at its cost. Okay. Provided if there is any permanent reduction in the value, permanent diminution in the value of the investment, then that reduction will be accounted for. Okay. Otherwise, the long-term investments will be carried at its cost. There is no doubt about it. You're getting it? So this is as per AS 13. Remember, short-term investment will be carried at its cost or at its FMV, whichever is lower. FMV as on when? FMV as on closing date, that is 31st March, balance sheet date. Alright. Now coming back to your long term will be carried at its cost at any point of time, provided if there is any permanent reduction in the value of the investment, then such reduction will be accounted for. Such reduction will be taken into consideration. Otherwise, no. Hope you are understanding. Next one. As per accounting standard, PPE does not cover. PPE means AS 10, plant, property and equipment. Remember, guys, each standard, you take or any standard, there will be two sections. One is applicability and the second one is non-applicability. Remember, we have given this separately for all the standards. So this is basically a theoretical question. I request you to read through at least this section, memorize this section for all the standards. You're getting it? Because you should know for which one the standard is applicable, for which one it is not. Why? Because there are separate standards for those items. So it will be accounted based on those standards. You're getting it? So this question is one of its kind, which asks that your AS 10, which is not applicable. AS 10 is nothing but PPE, plant, property and equipment. So AS 10 is not applicable for what? There are around some 3-4 items, guys. I've given in the explanations also. In this option, the answer is, both B and C, that is biological asset and non-regenerative resources. These two things are not covered under PPE. Alright, I have given it. It is a theoretical question because PPE is related to all your fixed assets, that is properties, fixed assets, equipments, plant and machineries, and your buildings, and then plant to bearer plant. It includes only bearer plant, not for anything else. You are getting it? So please remember this. Read through this theoretical portion. You are getting it? Just a moment. Let me see. All right. Now, next question is, which one of the following is incorrect? Remember, This questions, these type of questions, you have to read through all the options. Then you have to pick one which is the, I mean, if the question is asked for which is correct, so correct, which is wrong, which is incorrect, or incorrect. Ma'am, why these type of questions are asked? Guys, understand when these type of questions are asked, I mean, why I use these questions are, you have to read the concept, you have to understand the concept very well, then only you can say which is incorrect, right? You, only if you know which is correct, then only you can say, okay, I know this is correct, and then that is not correct. So that's the reason. So this will give you very much clarity on the concept. Unless you are very much good in the concept, you cannot answer these type of questions. You are getting it? Again, if you read these choices, buyback, it is talking about buyback. So this is this particular question, all right? Not only this particular question, this particular chapter, buyback chapter, you have to read along with Companies Act. Okay, you have to read along with what? Companies Act, because Companies Act have told so many provisions which has to be followed. Along with that, accountancy follows. You're getting it? Because Companies Act has laid down certain rules that securities premium cannot be used for so and so purposes. Buyback can be done only to this extent, and buyback, during buyback you can pay premium, but that premium can be adjusted against, or the premium can be paid out of only so much resource, all right, against this resource, and not against this resource. If it is a public limited company, then how you have to do it? If it is other than public, what SEBI says, you're getting it? So there are so many provisions related to buyback which you have to study along, even for your commerce section. It is not that commerce section is different and Companies Act is different. No. Why? Because since you're studying accounting for the corporates, basically it has very much it has its influence from the Companies Act, because the accounting standard, whatever you are studying, no, this accounting standard and everything, it was made mandate because of the Companies Act. Companies Act have told very clearly that the corporates have to follow accounting standard, have to incorporate accounting standard. You're getting it? So remember, you have to be good enough in your Companies Act to make sure while preparing your financial statement of a corporate. You're getting it? Not only that, even accounting also. All right. Now, in this, premium paid on buyback can be adjusted against securities premium. First of all, understand securities premium. Securities premium means what? When you issue a shares, or when you issue a equity shares or preference shares, whatever it is, when you issue at a price more than par, greater than a par value. Par value means face value, or more than a face value, then that hike in the price is called premium. I hope most of you guys know that. You're getting it? Practically in the market, you might be seeing it. Accounting, in technical knowledge or in bookish knowledge, I'm telling you. So when the issue price is greater than the face value, it is called premium. That is called securities premium. So this premium amount, what I collected, I used to keep it in a reserve. Ma'am, you can't use it. I cannot use it for any purposes. No. I have the purposes given. Companies Act clearly told me, when you collect a premium, when you have a premium reserve, when you have a security premium reserve, then those reserves can be utilized for certain purposes. There are around some 6 purposes the Companies Act has mentioned. So only for those 6 purposes you can use it. Other than that, you cannot touch this securities premium. Simply you cannot use it for your everyday activity, everyday no, that is not possible. You cannot use it. You're getting it? You cannot I just use that money for the traveling, but no. They have given certain reasons, they have given certain certain points that against what you can use the securities premium. So in that, one of the kind is buyback. When there is a buyback, and if you're buying back at a premium price, buying back means what? When the company is asking the public that I will pay the money, you please give me the shares back. You're getting it? You give the shares back to me. Guys, usually when you buy shares, when you buy or when you trade, you will be buying shares and you will be selling it to the other person. The third party would be an individual like you or some other investor. Correct. So that is what usually you would have come across. But buyback is something the issuer company, suppose Infosys has issued shares some 10 years before. Now they are coming and saying to the public, Baba, I have huge reserves. Now I wanted to give back to my shareholders. So what I'm doing is I am paying the money. I'm giving you some price. You please give the shares back to me. I will take back my shares. That is called buyback. There are certain procedures for that, how much you can buy back, and how what are the procedural things you have to follow. All those things are mentioned in Companies Act. We have given that in the lecture also. We have given that in accountancy section also. Both the places I have covered. Companies Act also I have covered, and even in accountancy also I have covered. You're getting it? Now coming back here. So now the buyback, when Infosys is saying that okay, I will buy back at say 50 rupees or 100 rupees, it's at a premium. So when there is a premium on buyback, for that you can use the securities premium reserve. That is the thing that is given in the Companies Act. Now what they are saying, when the premium on the buyback is there, against what and all you can adjust. You can adjust against securities premium, you can adjust against free reserves, you are getting it, you can adjust against general reserve. But please remember, revaluation reserve is something you cannot do it. Why? Because revaluation reserve you cannot do it? Revaluation reserve is a notional reserve. It's not a real reserve. It is not a real profit. It is not a real gain. Revaluation reserve is just a notional gain. You're getting it? Notional stuff. So when it is a notional stuff, you cannot use the same thing for, which is actually happening. You're getting it? Premium on buyback is actually happening. And for that, you cannot use something which is not real. You cannot use such resource which is not real. That is absolutely nonsense. You're getting it? In that case, you're eroding the capital. All right. So now what happens here? Now they are asking which one is incorrect. Now I know that it cannot be adjusted against revaluation reserve. So that should be the answer, because that is if the option says that I can adjust against revaluation reserve, then that is incorrect, right? So I cannot adjust against revaluation reserve. So now my question is, which is incorrect? So let me read. Premium paid on buyback can be adjusted against securities. It is right. Premium paid on buyback can be adjusted against free reserve. Right. Premium on buyback can be adjusted against revaluation reserve. No. Can be to no. It cannot be adjusted. So this is correct. So which one is incorrect then? Option C is incorrect. You're getting the answer? All right. Next one. Dash is the time period between grant date and the date in which all the conditions of ESOPs are satisfied. Guys, remember, this one is from your ESOP chapter. Alright, there is one chapter called Employee Stock Option Scheme or Sweat Equity, whatever it is. So that is ESOP. So there, these questions will be coming up. These concepts will be coming up. In ESOP, there are so many definitions. Alright, vesting date, grant date, exercise date, and then what I can say, exercise period. All right, and then vesting period is there, and then what else you have? These things are there, and then intrinsic value, and then X right, come right. So there are so many. No, right will be X right, come right will be coming in rights issues. ESOPs only these things, and ZAR, stock appreciation rights, cash settled, equity settled. So many things are there. All right. Now the question here, it talks about a time period. This ESOP starts from the date when it is granted. Basically, grant date is something when the company announces it. Baba, see, they'll come and make an announcement. See, you are eligible for 100 options. All my employees are eligible. So that's a grant date. I have given you that. You are eligible for 100 options. Okay, fine. You said I'm eligible for 100 options, or you are eligible for 100 shares. So right now, am I eligible? If they say, okay, right now, then that is your grant date, that is your vesting date, everything. But what now they are saying, no, 100 shares are available for you. I agree. You can buy this 100 shares at rupees, say 5 rupees, 2 rupees. But you have to stay with me for next 3 years. You have to perform so much. So that they put some conditions. Okay, you are eligible. Guys, understand now. Infosys is coming. Why I'm taking Infosys? Everybody knows it, so I'm just using that. Now Infosys, say for example, Infosys is coming and telling their employees, Baba, the shares are now available in the market by say 3,000 rupees, 4,000 rupees per share. Say I'm going to give you 100 shares for rupees 10 each. Just remember, 10 rupees, that's it, right? So 10 rupees you can buy my shares, you can buy directly from me, but provided you have to meet these expectations. That could be, they will say you have to work with me for 5 years, you should work with me for 3 years, or you should exceed the expectation by 80%, 60%, whatever it is, that performance. All right. So now after, once you satisfy this condition, you will be eligible to buy those 100 shares from the company at rupees 10. All right. So now the grant has happened in 22. All right. Now the company has told it. Today they announced. So 23. Now what they are saying, Baba, you will be eligible for 100 shares at rupees 10 rupees if you stay with me for 2 years. So now what happens? 2023 grant has happened. And 2023 to 24, 24 to 25. So 2 years I have to stay. 23 full, 24 full. So 2025 January, I am eligible for that shares. So now 2025 January will become the excise period, the last day, that excise period. Why? Because I got my shares. I have satisfied the condition. Now there is 2 years time gap. No, from 2000 grant and the excise period, conditions are met, right? So now what is this period is called? This is called vesting period. This is called what? Vesting period. All right. So that vesting date, vesting period. So I have to satisfy my conditions during this period. Then only I will earn my right to buy that shares. You are getting it? So the answer is B, vesting period. All right. Now, under cash settled method, provision for dash will be valued at each dash date. Please remember, ESOP accounting has, how to account ESOP, that is there. There are two ways. One is equity settled and another is cash settled. And third one, we will say hybrid. So hybrid, I'm not worrying much because it will be more or less treated as cash settled. So equity settled or cash settled. Equity settled, though, that I said, no, you can buy that 100 shares. So company will say, okay, fine, you give me 10 rupees, you will take 100 into 10,000 rupees you give me, you take 100 shares. So they will allot 100 shares to the employee. So that is done. That is equity settled. But whereas cash settled means what? Cash settled means the company will not give shares to the employee. The company, what they will say, Baba, see, these 100 shares are valued so much, so I will give you that much money to you. That's it. Instead of giving equity shares, I will give them the paisa, equivalent paisa. That is called cash settled. And the excise period, on the excise date, vesting date is over. When they earned the right to receive that shares, on that day they'll come and say, Baba, I'm not going to issue shares. Rather, I will give you the paisa equivalent to that shares. That valuation will happen. Share valuation will happen. What are the values coming up? That amount I will give it to you. That is called cash settled method. Now they are asking, under cash settled method, there are various, because the method of accounting is different for both the stuffs. If it is equity settled, the method of accounting is different. If it is a cash settled, the method of accounting in the books of the company is different. So now the question here is, if it is a cash settled, what will you do? First thing, it is called as stock appreciation right, ZAR. It is called as what? ZAR. Stock appreciation right. First thing, we will not call that as ESOP because we are not going to issue equity shares there. We are going to give them money. So for that, we will create one ledger called ZAR, share appreciation or stock appreciation right. All right. Now what we will do, every year we will create this provision, because as a company, I am liable to pay so much of amount to my employee at the end of second year. So at a stretch on the second year, I cannot come and park such a bulk amount in my books. So my books will go haywire. Right. So now what happens? I don't want to do this. I know that as soon as I announced, I know that as a company, I know that I am obliged to pay All right, this much amount at the end of the second year. I know that. So once I know that, I'm making a provision for the same in my books. Okay, I'm making a provision for the same in my books for the next 2 years, so that I won't be in a trouble in the end of second year while I'm making the payment. So for that, what this accounting standard, again, this is handled by another accounting standard called employee benefit. All right. So now AS 15. So what it says is, please create a provision for ZAR. All right. Please create a provision for ZAR. All right. And every balance sheet date, the value, and it will be valued at what? Each balance sheet date. So every balance sheet date, you have to revisit and you have to value the shares, and based on that, you have to adjust the provision amount. That is the point given under AS 15 ESOP ka provisions. All right. ESOP ka points. You are getting it? So now the answer is, under cash settled method, provision for stock appreciation right will be valued at each balance sheet date. Revalued every time, it will be valued. Every balance sheet date until the vesting period is over, it will be valued every last time. If it is balance sheet date, I will value, if the share value is say 200 rupees, next balance sheet date if it is 220, then further 20 rupees I have to increase my provision. All right. So like that, during the vesting period, it will be happening. If it is 2 years, so 2 years. If it is 5 years, so 5 years. 10 years, so 10 years. You're getting it? So ZAR will be accounted in such a fashion. All right. Yes. Hope you guys are getting it, I believe. All right. If you have any doubts though, you can post me so that, or you can write a mail so that I can get back on your doubts. All right. I have few more questions to go. Let me complete with this question today. So in the next video, we can see further questions also. All right. In this, if you have any doubts, so let me know. All right. So the next question, last question for the day. According to the accounting standards, an accounting policy can be changed if the change is required. Guys, this is very important. Why? Because remember, you cannot keep on changing the accounting policies as you like. No, because the main purpose, guys, why you are preparing financial statement is why it is like, progress card, right? Say for example, you prepared one type of ranking system in your quarterly, next type of ranking system in half yearly, another type of ranking system in annually. Though, how do you compare your performance? You're getting it? You cannot compare. Hey, last time here it was like this time it was like this. No, you cannot compare yourself. No, the same thing. Guys, understand, when you keep on changing the accounting policy, it becomes very difficult for comparison. It becomes difficult for, analysis. So what Accounting Standard and Companies Act told is very clearly, if it has been told that you can change your accounting policy only if it is required by the statute. Statute means it is law. If it is required by law, you do it. All right. Or if it is required by the accounting standard, you do it. Or if it is for a better presentation, you do it. Otherwise, please don't do. Only 3 reasons they have given. Statute, if it is required by the statute, if it is required by the accounting standard, or if it is for a better presentation, all right, of the financial statement, then you can change your accounting policy. Otherwise, no, you should not keep on changing your accounting policy. Remember, it is not so easy. Ma'am, I can just change better presentation. No, when you are changing your accounting policy, it is not only current year you have to do, you have to change accordingly for your previous year, because every time you will be presenting 2-year ka data, unless it is a first year, you will be presenting 2-year ka data, 2 annual year data you will be presenting in your financials, current year and the previous year, so that whenever the reader is looking at the financial statement, they can compare, okay, previous year you are like this, now you are like that. Okay, so when you change the accounting policy this year, the same thing you have to do it for the previous year also. Simply you cannot put previous year as it is, only current year I will make the changes. No, you have to present represent your financial statement in same accounting policy for both the years, and the impact analysis also you have to give it in your financial statement. You have to disclose it. Baba, last year I valued my inventory on FIFO method. This time I am valuing it on weighted average method. So because of that, last year inventory, if you see our last year balance sheet or last year financial statement, this much would have been given, and but because of weighted average, my inventory has gone up to so much, my inventory has gone down to so much. So you have to give those impacts. You're getting it? So that kind of disclosure should be made. That kind of disclosure should be made in your financial statement when there is a change in the accounting policy. You're getting it? Remember, you cannot keep on changing your accounting policy as and when it is required. You can change your accounting policy only when there is a requirement by the statute or by an accounting standard, or if it is for a better presentation of the financial statement. All right, hope you guys got these questions. If you have any doubts though, please post your or mail your queries so that I can answer. So today I'll wind up with this. All right, today I'll wind up with this so that we can continue on the next class. I'll be doing MCQs for the next classes also, so that we will, so because so many classes we have seen theoretical, so now we will be solving few questions, MCQs. All right, see you guys. I wish you good luck today. Take care. Bye bye.